For the first time since Silicon Valley Bank collapsed in March 2023, the largest pool of capital on Earth has made a decision. Rates are going up from here, not down. I'm not the one saying this, the bond market is. And right now, the stock market on Wall Street is pretending it hasn't heard a thing. Let's start with a picture. The bond market and the stock market are staring at the same elephant from opposite ends. The bond guys have their hands on the trunk, the stock guys are pulling the tail. Both are convinced they've got the truth. But here's the thing, they're touching the same elephant, and that elephant is not in a good mood. For the past 3 years, the bond market has been doing one thing, betting on rate cuts. Every 12 months, it wagered that the cavalry is coming. 36 straight months, no exceptions. Then, last week, the blue line, representing market expectations, crossed above the green line set by the Fed for the first time. In plain English, the bond market has officially declared the cavalry is not coming. Now, you might ask, why should we listen to the bond market? The answer is simple. People who lend money for a living lose their jobs when they're wrong. People who buy stocks only lose their jobs when they're early. Guess which market is more willing to face reality? Historically, when the bond market and stock market diverge this sharply, the bond market is right 4 times out of 5. That's not my opinion, that's the data. So what exactly does the bond market see? 3 words. America is broke. Not skip the latte broke. Selling plasma broke. The 10-year Treasury yield shot from 1.5% to nearly 5% in 18 months. In the bond world, that's the equivalent of your grandmother doing a backflip off a garage roof. Sounds insane, right? Why? Because America spent the money on a bridge that connects to another bridge, 47,000 consultants named Brad, and a $13 billion aircraft carrier taken down by a laundry room fire. $13 billion defeated by a lint trap. And that was just the appetizer. You might be thinking, no big deal, just fire up a printing press. But this time, the printing press is truly out of order. Last week, the producer price index surged 6% year on year, the hottest since 2022. The consumer price index hit 3.8%, a 3-year high. Now, tell me, facing 6% PPI, how do you print money? You can't. All you can do is sit there and watch. Gasoline is $4.56 a gallon nationally, $6.14 in California. That is the highest May figure AAA has ever recorded. When gas prices go vertical, inflation follows like a lit fuse. That's why the Fed right now is not cautious, it is paralyzed. Now here's the strangest part. While the bond market is sounding the alarm, the S&P 500 just hit a fresh all-time high. On one side, bankruptcies are up 42%, small business filings up 46%, credit card delinquencies back to Great Recession levels, and subprime auto repossessions at their highest since 2009. On the other side, stocks are making new highs. What does that look like? It looks like a patient whose vitals are all deteriorating, but the thermometer says everything is fine. Because the stock market doesn't look at the present, it looks at expectations. And that expectation is built on the AI boom. AI has been the anchor of this entire bull run. Without that show, the whole rally might have ended long ago. But here's the problem. This resilience is built on sand. Consumers' real incomes are already contracting. The so-called consumption growth is propped up by draining savings. Both consumption and investment are heavily dependent on the wealth illusion that asset prices only go up. The moment that illusion shatters, the entire chain goes into reverse. Now let's add the rate hike variable into the equation. The impact of rate hikes on stocks is never a one-way street. It transmits through 2 paths. Path 1, valuation contraction. When rates rise, future money is worth less. Growth stocks, especially tech, get their valuations crushed. Path 2, earnings support. Rate hikes usually happen when the economy is running hot, so corporate earnings are still climbing. That's why historically, stocks don't necessarily fall during rate hike cycles. Over the last 12 hiking cycles, the US market averaged a 9% gain with positive returns in 11 of them. But that only holds when earnings growth outweighs valuation contraction. And here's the current problem. Inflation is too hot for the Fed to cut. The economy is too fragile for the Fed to hike. This is what I mean by 3 doors, all traps. Door 1, hold steady, probability 60%. Bankruptcies slowly bleed out, and the stock market keeps drifting on illusions. Door 2, hike. Probability 25%. The new Fed chair decides credibility is worth a recession. Stocks finally get the memo, and the snap is fast. Door 3, cut. Probability 15%. Something breaks first, forcing a cut. But with gas at $5, the dollar collapses and gold goes vertical. 3 doors, leading to the same room. Dollar devaluation, just at different speeds. Finally, let's look at one detail. Berkshire Hathaway is sitting on $397 billion in cash, a record. Not $39 billion, $397 billion. The richest old man in Omaha and his handpicked successor are not predicting a crash. They're just sitting there, holding the equivalent of a small country's capital. What are they waiting for? A clearance sale. The bond market has already given you the answer. The clearance sale Buffett is waiting for may be on its way. So today, I want to leave you with 3 things to remember. First, when the bond market and the stock market disagree, listen to the bond market. Second, the printing press is not all powerful. When inflation hits the accelerator, the press stalls out. Third, the elephant has 3 sides, but only one body. No matter which door the Fed picks, the room behind it is the same. A rate hike itself is not the disaster. The disaster is seeing the alarm clearly and still choosing to believe that only what you see is the truth. Last but not least, if you enjoyed this breakdown, do hit that like button and subscribe. Data reveals the truth and logic guides the way. I'll see you in the next one.